Federal Reserve is doing something right now that they have not done since before the great financial crisis, and before that, the dot-com bubble burst. This right here is a chart of the federal funds rate versus the 2-year Treasury yield. And as I'm about to show you, this chart indicates that the Federal Reserve may have already set into motion a recession and potentially even a severe one. If you don't know who I am, my name is Joe Brown. I'm a former stockbroker who spent years advising the top 1% on how to manage their wealth. And after making enough money to leave that corporate world behind, I turned my attention to teaching people financial strategies that exist outside the mainstream, things you'd never hear from your typical stockbroker or financial advisor. So first, let's take a look at the 2-year Treasury yield. This is the interest rate that the government pays on its debt when it borrows money for 2 years at a time. Currently, the 2-year yield is at 3.6%. Contrast that with this chart, which looks almost identical in terms of the shape. However, at certain times, the interest rate is significantly different, like right now. The federal funds rate is currently in a range between 5.25 and 5.5%, which compared to the 2-year is almost a full 2% difference. Now, if we want to know how extreme of a difference this is, all we have to do is put the two charts together to look at the federal funds rate over the US 2-year yield. So let's walk through exactly what we are looking at right now. This horizontal line at 1 represents when the federal funds rate and the 2-year yield are identical. For example, if the Fed funds rate is 3% and the 2-year yield is also 3%, well, putting 3% over 3% gives you a value of 1, which means that the vast majority of the time, this blue line is going to be below the horizontal 1 level. And that is because the vast majority of the time, the 2-year yield will be a larger number than the federal funds rate. This makes sense because the federal funds rate, which is the only interest rate the Fed actually controls, is an overnight rate, whereas the 2-year yield is the amount of money the government pays for its debt to borrow for 2 years. So you would expect that an overnight rate would be lower than a 2-year rate, just like a 15-year mortgage has a lower rate than a 30-year mortgage. That's how the yield curve works. In a normal environment, debt that matures over a longer period will have a higher interest rate. Debt that matures in a shorter period has a lower interest rate. So anytime you see this line below the 1 level, we are in a normal yield curve environment where the 2-year has a higher interest rate than the federal funds rate. But that is not where we are at today. And the extreme differences between the 2-year and the federal funds rate indicate some potentially extreme warning signs for the economy. Anytime this chart is above the 1 line, it means the federal funds rate is a higher interest rate than the 2-year yield. The last thing I'll point you to on this chart is these bars, which indicate recessions. And as you might have already noticed, prolonged and extreme levels of the Fed funds rate being higher than the 2-year yield usually result in recessions. That was true in 1990, which was preceded by this spike. That was true when the dot-com bubble burst, which was preceded by this spike and this spike. That was also true during the great financial crisis, which was preceded by this spike. And most recently, that was true during the 2020 recession, which was preceded by these spikes. Given the extreme spike we are seeing in the Fed funds rate right now, which is only rivaled by the great financial crisis and prior to 2020, and how long this elevated level has been around for so far, would indicate a big red flashing warning sign for the economy. But at this point, if you have any critical thinking skills, you're probably asking, why? Because correlation does not equal causation. And while there is some correlation between an inversion of the Fed funds rate and the 2-year yield, is there any logical mechanism by which that would translate to problems with the economy? Well, I'm glad you asked, because the answer to that is yes. For an answer to that, we need to first understand what interest rates are. Interest rates are very simply the price of money. It is the cost to acquire money. And just like the price of anything, it is a function of supply and demand. normally. Prices get driven high by a massive boom in demand, and then that incentivizes new supply to come in. But once there's too much production, you have an oversupply of something. Now, if you're the producer, you're not able to sell as much of it as you want. You're gonna have to continue to lower and lower and lower your price until it gets down to a point where demand comes back in and buys up your supply. And if we had a truly free market in money, this is how it would work with money as well. If the savings pool is very large, everybody has a ton of savings, we're not spending it, we're not investing it, we're just keeping it off to the side, then the person who wants to borrow is going to have their pick of the best interest rate. They might come to me to borrow and I would say, hey, you can borrow from me for 5%, but the guy next to me has a bunch of money as well. And so he says, well, you can borrow from me at 4%. But then the next guy in line says, well, you can borrow from me at 3%. And because the savings pool is so large, we're going to bid against each other. That's going to push down the interest rate as we compete to get that one borrower. But because interest rates then are so low, there's really no advantage to me keeping my money in savings. So I'm going to go out and spend. I'm going to go out and invest. And heck, I might even borrow because it's cheap to do so. So a large savings pool drives interest rates down, which pushes that money out of savings into productive use. But as that imbalance gets changed and every saver becomes a spender and becomes an investor, now that savings pool gets drained. Suddenly everybody is a borrower and everybody is a spender. Power will then shift back into the hands of the savers and the lenders. Anybody who still does have some money saved will be able to ask for a higher and higher interest rate because so many people are spending and borrowing that now there's much more demand for debt. And maybe somebody comes to ask to borrow from me and I'll say, hey, I will lend you my last dollar at 10%. But then another borrower says, well, I'll pay you 11% for that because I want it more. Maybe another borrower says, I'll pay you 15% because I want it even worse than that. And so me as the only person with any savings left will have the ability to choose any borrower at any rate that I want. That's a huge profit potential though, and that incentivizes people to stop spending, stop borrowing because it's so expensive, and start saving so they can be back on that side of the saver and the lender. So a free market in money and interest rates will naturally incentivize the savings pool to be balanced against interest rates. If we have too large of a savings pool, interest rates will go down and money will be spent and invested. And if that happens too much, then interest rates will go up and incentivize saving again, and it'll keep everything roughly in balance. But if you're a smart cookie at this point, you're thinking, well, we don't have a free market in interest rates. And you're exactly right. That's what we're looking at with this chart, which is the federal funds rate, which is 100% set and controlled by the Federal Reserve, hence the name Fed funds rate. Now, it's true that the 2-year yield is more so set by the free market, though not completely. These bonds are bought and sold all day long by individuals and institutions, which pushes the price up and down. Now, the federal government and the Federal Reserve can both be buyers and sellers of the 2-year Treasury. So there is influence, artificial influence on the 2-year Treasury yield as well. But it is not 100% controlled by a central planner like the Fed funds rate is. This 2-year yield does have a lot more free market influence on it. So big moves, especially like recently, a big drop in the 2-year yield can indicate a big supply and demand change. And because what we just talked about, that the interest rate on debt is an indication of the savings pool being either too low or too high, a big move in the yield on debt can indicate the market is reacting against the central planners. By the way, if you would like me to help you apply ideas like this to your investing so you can grow your wealth faster and protect it during times of crisis, click on the link in the description below. But why would a significant drop in a more free market rate like the 2-year yield compared to no drop in something like the federal funds rate, why would that indicate that the Fed funds rate is wrong? Well, it's because a controlled interest rate is by definition not the natural interest rate. Now, we can get a better idea of what the real interest rate should be or what the natural rate would be by looking at debt that is more controlled by the free market. But just by definition alone, an interest rate that is controlled from the top down by an entity like the Federal Reserve is never going to be the natural rate. Well, I guess I shouldn't say never because a broken clock is right twice a day, but rarely it's going to be right because that's the intended purpose. Whether it's with laws or fiscal policy or monetary policy, the only reason it's being done is to change behavior. It's the reason why there is no law that people have to sleep every night, because as humans, we do sleep every night. There's never going to be a policy that just reinforces the behavior that would be there otherwise. The entire point of policy is to cause something else to happen that is not naturally happening. And that's what we see with the federal funds rate. It is an attempt to either overstimulate the economy with the price of money relative to what it would be otherwise, or over tighten the economy with the price of money relative to what it would be otherwise. And the bigger the difference between the controlled rate and a more free market rate indicates that the controlled rate is more wrong, either over easy or over tight. Artificially low rates, when the controlled rate is significantly lower than a more free market rate, still signals spending and borrowing. Like in our example, if interest rates are low, you're not going to want to keep money in the bank and not profit on it. You're going to want to spend, and you're actually going to want to borrow because borrowing is cheap. Artificially low rates incentivize spending and drain the savings pool. But because it's not the natural rate, it artificially drains the savings pool to a much larger extent than you should, which means there's a lot more demand for investment and consumption than there would be otherwise, which causes more asset and goods inflation than there would be otherwise. Or in other words, this is the boom of the boom bust cycle. And when it starts to overheat and they realize, man, this is really getting away from us, then they flip to being artificially tight. When the controlled interest rate is significantly higher than a more free market rate, it signals saving and lending now. This incentivizes any money that is out to work in the economy to stop going out to work, pull back, to stop spending, stop investing, save it, take advantage of those high interest rates, and underconsume, because the profit opportunity of savings incentivizes sucking that capital out of the economy. Just like in our example, these high rates still send that signal, but to a much higher degree than it should be, which chokes out spending and investing, triggering recessions. Or in other words, the start of the bust of the boom bust cycle. If you've been tracking this whole time, you can see that a boom bust cycle is not a business cycle, it's a debt cycle. And it's not a natural debt cycle either. It is one imposed on the system through artificially set interest rates. And if history is any guide, we are now at the level of extreme that indicates a severe crash or recession, or both, just like we had in 2020, just like we had in the Great Financial Crisis, and just like we had in the dot-com bubble burst. Now, these things do take time to get set into motion, and so even if the Federal Reserve embarks on an aggressive rate cut cycle right now, it is likely too late to avoid the bust. Now, I need to be clear with you. I am not saying I think the Fed should have cut rates earlier, or that they should cut rates more. I don't think the Federal Reserve is capable of doing this job, because by definition of this job existing, you are distorting the economy. You are sending false signals to economic actors on whether to spend or save. It is simply price controls, but it's price controls on the one good, money, which is half of every transaction. We don't need the Fed. Every single thing the Fed does can be done by the free market better. They shouldn't exist. And to the extent that they do, they impose policies on the economy that either cause artificial booms or artificial busts. And if they were able to impose a rate that was just right in the Goldilocks zone, they would simply be doing what the market would be doing without them, which still means there's no point. They are the orchestrators and the source of false wealth creation and real wealth destruction. And right now they are leading the blind straight over a recessionary cliff. And if you'd like me to help you apply ideas like this to your investing so that you can grow your wealth faster and, most importantly, protect it during times of crisis, click on the links in the description below. As always, thank you so much for watching. Have a great day.